Canada's Prime Minister Mark Carney is traveling to India, Australia, and Japan with a very clear objective, and that objective is to reduce Canada's heavy economic dependence on the United States. And this is not speculation. This is being openly described as an effort to diversify trade and secure new partnerships outside of North America. And that matters because right now, the United States is by far Canada's largest trading partner, with roughly 3/4 of Canadian exports going south of the border, which means that any political tension, any tariffs, any policy shifts in Washington can directly shake the Canadian economy. And over the past few years, trade disputes, protectionist signals, and economic uncertainty have made that dependence look like a strategic vulnerability rather than just a convenience. So what Carney is doing is signaling that Canada wants options, and the countries he's chosen are not random. India is one of the fastest growing major economies in the world, with a massive consumer market, expanding manufacturing capacity, and growing geopolitical weight. Australia is a resource powerhouse with deep ties to Asia and strong alignment with Western economies. And Japan is the world's third largest economy, a technological leader and a key player in critical supply chains, especially in areas like semiconductors, clean energy, and advanced manufacturing. So when you put those three stops together, you start to see a pattern. This is about supply chains, energy security, critical minerals, technology cooperation, and long-term market access, not just symbolic diplomacy. And it comes at a time when the global economy is becoming more fragmented, not less. Countries are thinking more about resilience than efficiency, more about trusted partners than just the cheapest supplier. And Canada is rich in natural resources, critical minerals, agricultural exports, and energy. But it needs stable, diversified buyers and investors to reduce its exposure to one single market. So this trip is about sending a message that Canada intends to anchor itself more deeply in the Indo-Pacific economic network, which is increasingly becoming the center of global growth. Now, to be clear, this is not Canada walking away from the United States. That's not realistic, and no serious policymaker is suggesting that. But it is about recalibrating leverage, because when one country buys the majority of your exports, it holds significant influence over your economic stability, and diversification changes that balance even slightly, and even a small shift in export destinations, investment flows, or long-term contracts can alter negotiating power over time. So when Carney meets leaders in New Delhi, Canberra, and Tokyo, the focus is expected to include trade talks, investment frameworks, clean energy collaboration, defense, cooperation, and critical mineral supply agreements, which are all sectors that are strategically important in today's geopolitical climate. And what makes this trip more than symbolic is that it's happening against a backdrop of global supply chain restructuring, where countries are actively trying to build alternative trade corridors and reduce strategic risk exposure. So, in simple terms, this is Canada trying to future-proof its economy by building multiple strong economic bridges instead of relying primarily on one. And whether those bridges become highways or remain side roads will depend on what concrete agreements or negotiations actually come out of these meetings. But the direction itself is unmistakable. Canada wants diversification, stability, and expanded influence in the Indo-Pacific, and this trip is the first visible step in that strategy. Now, before we go further, the real question becomes, is this just diplomatic signaling, or could this mark the beginning of a long-term structural shift in how Canada positions itself in the global economy? Now, let's go deeper into why this move is happening now, because timing is everything in geopolitics. And this trip is not happening in isolation. It is happening during a period of renewed trade tensions, rising protectionist policies, and increasing uncertainty in North America. And over the past few years, we have seen tariffs, disputes over subsidies, disagreements over industrial policy, and a growing political conversation in the United States about reshoring industries and prioritizing domestic production. And when your economy sends the majority of its exports to that market, that kind of political shift creates risk, even if relations remain officially friendly. So from Ottawa's perspective, diversification is not about emotion. It is about insulation. It is about reducing exposure to decisions that Canada cannot control. And that brings us to India, Australia, and Japan, because each of these countries offers something strategically different. India offers scale and growth. It is projected to remain one of the fastest growing major economies for years, and it has a young population, expanding middle class, and increasing demand for energy, food, and technology partnerships, which Canada can supply. Australia offers alignment and resource synergy. Both countries are major exporters of critical minerals and energy, and both are looking to secure supply chains that bypass unstable routes. And Japan offers technological depth, capital investment capacity, and long-term industrial cooperation, especially in areas like advanced manufacturing, clean energy infrastructure, and battery supply chains. So this is not random diplomacy. This is targeted diversification into three pillars: growth, alignment, and stability. And another important factor here is the global shift toward supply chain security. After the pandemic and recent geopolitical shocks, governments realize that efficiency alone is not enough. They want trusted partners and predictable frameworks, and Canada fits into that conversation because it is politically stable, resource rich, and aligned with democratic institutions. But at the same time, Canada also needs reliable buyers and investors outside of a single dominant partner. And when we talk about diversification, we are not talking about replacing the United States. That is unrealistic. We are talking about marginal shifts that compound over time. Even if Canada moves 5 or 10% of future export growth toward Asia, instead of the US that gradually changes dependency ratios and negotiating leverage, and over a decade that matters significantly. And there is also an Indo-Pacific strategy dimension here, because the Indo-Pacific region is expected to account for the majority of global economic growth in the coming decades. So positioning early and strengthening bilateral ties now means being embedded in that growth trajectory rather than reacting later. And for India, specifically, there is an additional layer because Canada and India have had strained relations in recent years. So restarting structured trade discussions or signaling renewed economic engagement suggests an attempt at pragmatic reset focused on economic interests rather than political friction. And with Japan and Australia, there is already strong alignment, but expanding that into deeper economic integration, especially in critical minerals. Clean hydrogen, liquefied natural gas, and advanced technology would strengthen a network that is less vulnerable to unilateral disruption. And this is where the bigger strategic logic becomes clear. Canada is not just diversifying customers, it is integrating into a multi-country economic framework where supply chains, investments, and energy flows are interconnected so that no single decision from one capital can freeze the entire system, and that reduces systemic risk. And from a market perspective, investors often look for stability, predictability, and diversified exposure. So, signaling that Canada is actively building alternative economic corridors can also influence long-term investment confidence because it shows strategic planning rather than passive dependence. And this is why the trip is drawing attention, not because diplomatic visits are unusual, but because the stated objective is explicit diversification. And when a G7 country publicly signals that it wants to reduce reliance on its largest trading partner, that is strategically meaningful, even if the change happens gradually. And that leads us to the next key question. What are the realistic outcomes of this trip, and what would count as real progress versus symbolic headlines? Now, the key issue is what would actually count as real progress from this trip, because diplomatic visits alone do not change economic structures. What matters is whether measurable steps follow the meetings in India, Australia, and Japan. And the first concrete indicator would be formal movement on trade negotiations, especially with India, because restarting or accelerating structured trade talks would directly affect tariffs, market access, and regulatory cooperation, which are the foundations of long-term trade expansion. The second indicator would be critical mineral supply agreements, since Canada holds large reserves of lithium, nickel, cobalt, and other materials that are essential for batteries, electric vehicles, and advanced technologies. And Japan, in particular, has strong strategic interest in securing stable, non-volatile supply chains. So memorandums of understanding, long-term contracts, or joint processing investments would signal integration into Asian manufacturing ecosystems. The third indicator would be energy-related agreements, including liquefied natural gas, clean hydrogen, or renewable technology cooperation, because long-term energy contracts create predictable revenue and reduce dependence on a single export destination. And the fourth major signal would be capital. Investment commitments, because diversification is not only about exporting goods, it is about attracting foreign direct investment into infrastructure processing, facilities, technology partnerships, and advanced manufacturing inside Canada. And if companies from Japan, Australia, or India expand their investment footprint, that builds structural interdependence rather than transactional trade. And beyond formal agreements, the language used in joint statements also matters, because diplomatic wording often reflects strategic intent if leaders emphasize resilience, supply chain security, long-term cooperation, and trusted partnerships. That indicates alignment beyond short-term commercial deals. And alignment is increasingly important in a global environment where economic decisions are tied closely to security considerations. And it is also important to keep expectations realistic, because no country can quickly redirect decades of trade concentration, but what can happen is gradual rebalancing, where future growth is directed toward new markets instead of reinforcing existing dependency. And even a shift of 5 to 10% of incremental trade over several years can slowly alter leverage and exposure ratios. And from a domestic standpoint, diversification creates optionality, which means exporters have alternative buyers, investors have alternative partners, and policymakers have greater room to maneuver if disputes arise in one market, and optionality reduces vulnerability. Because when economic reliance is concentrated, shocks are amplified. But when trade flows are distributed, shocks can be absorbed more easily. And internationally, this move also positions Canada more firmly within the Indo-Pacific growth corridor, which is expected to account for a significant share of global economic expansion in the coming decades. And embedding early into that growth architecture strengthens long-term relevance. But again, the distinction between symbolism and structural change will depend entirely on follow through, our working groups established, our timelines set, our industry leaders engaged, our negotiation frameworks formalized, our contracts announced. These measurable developments are what transform diplomatic travel into economic restructuring, and ultimately, this strategy is about leverage and resilience rather than confrontation. It is about expanding the network of partnerships so that economic stability is not tied overwhelmingly to one capital, and whether this becomes a turning point or remains a strategic signal will be determined by what happens after the meetings conclude, and that leads directly into the final question, which is how sustainable this diversification effort is over the long term and what potential risks could slow it down. Now, the final and most important question is whether this diversification strategy is sustainable over the long term and what risks could slow it down. Because announcing diversification is one thing, but restructuring trade patterns that have been built over decades is another. And the reality is that geography still matters. The United States is physically connected to Canada, integrated through infrastructure pipelines, rail networks, electricity grids, and deeply embedded supply chains, especially in automotive, agriculture, and manufacturing. So complete reorientation is neither realistic nor economically efficient, which means this strategy must be gradual, strategic, and selective, rather than dramatic and immediate, and one major risk is execution. Because trade agreements take time, negotiations can stall, political leadership can change, and domestic industries sometimes resist adjustments that create new competition or regulatory standards. And another risk is economic gravity, because businesses tend to trade most with nearby markets due to lower transportation costs and established relationships. So for diversification to work, Canada must create incentives strong enough to overcome that natural pull, and that usually requires competitive pricing, stable policy frameworks, and long-term contractual certainty. And there is also geopolitical uncertainty, because the Indo-Pacific region itself contains strategic tensions and economic rivalries, which means Canada must balance engagement carefully to avoid becoming entangled in disputes that could disrupt trade corridors. And yet, despite these risks, the structural logic behind diversification remains strong, because global trade is becoming more multipolar, supply chains are being redesigned for resilience rather than pure efficiency, and middle powers that build multiple strong partnerships tend to have greater strategic flexibility over time, and flexibility translates into bargaining power, because when a country has options, it negotiates from a position of confidence rather than dependence. And that is ultimately what this trip represents, not a rejection of existing alliances, but an expansion of economic space and Attempt to widen the circle of stable partners so that growth, security, and investment are not overly concentrated. And if this approach succeeds gradually over the next decade, Canada could shift from being heavily US-centered to being more network-centered, integrated across North America, Europe, and the Indo-Pacific simultaneously, which would reduce vulnerability to unilateral shocks and increase its influence in setting trade standards and participating in emerging industrial ecosystems. But success will not be measured by headlines. It will be measured by data, export percentages, investment flows, new supply chain linkages, and long-term contracts. And those numbers take time to move. So the real story is not just this trip. The real story is whether consistent follow-through continues year after year, because diversification is a strategy, not an event. And if sustained, it could quietly reshape Canada's economic posture for a generation. And if not, it will remain a well-intentioned diplomatic moment without structural impact. And that is where this analysis lands. This is about leverage, resilience, and positioning in a changing global economy. And the next few years will determine whether this was the beginning of a shift or simply a response to short-term pressure.